imagine imagine curing cancer with artificial intelligence, right? And publishing your breakthroughs in the absolute top medical journals in the world.
Oh, yeah, the dream scenario.
Exactly. And on top of that, you announce your first ever corporate profit. You'd feel like you're just on top of the world.
You really would.
But then, you look behind the curtain and you see your own executives furiously selling off their stock.
Right.
While at the exact same time, your bank account is just quietly bleeding tens of millions of dollars.
I mean, it is the ultimate corporate paradox.
Yeah.
And it's exactly what makes the intersection of, like, advanced healthcare and high finance so incredibly difficult to navigate, especially for anyone watching from the outside.
Which is our exact mission for this deep dive today. We're unpacking the complex and honestly kind of contradictory signals coming out of Tempus AI.
Yeah, Tempus is such a fascinating case study right now.
It really is. I mean, if you just read the press releases, they're popping champagne. They just
Yeah.
reported their very first JAP profit in the second quarter of 2026.
Right, which is huge for them.
Over $5 million. 5.642 million to be exact in the black. Plus, they saw this massive 22% year-over-year revenue bump.
Yeah, that brings them to roughly $382.5 million for just the quarter.
Right. So it sounds like an unmitigated victory lap.
On the surface, absolutely. That is a phenomenal milestone. But as you dig into this, you really have to hold two totally opposing realities in your head.
Okay, what's the first reality?
The first reality is the undeniable, like, paradigm-shifting potential of what they're actually building, using artificial intelligence to fundamentally change how we diagnose and treat oncology patients.
Right, the actual science. And then I'm guessing the second reality has to be the gravity of their balance sheet.
Exactly.
Because, you can't cure cancer if you run out of money.
No, you definitely can't.
The underlying financials here, the heavy cash burn, significant insider selling, and this massive billion-dollar acquisition looming on the horizon, it suggests a company that is under immense metabolic stress.
Metabolic stress, I like that. That's actually the perfect way to phrase it. Before we diagnose the financial stress, though, we really need to look at the clinical engine.
Like how they actually made that money in the first place.
Yeah, exactly. How did Tempus AI actually generate that headline-making profit? Because they operate in a really unique space, right at the intersection of oncology diagnostics, pathology AI, and massive clinical data sets.
So they aren't just like a Silicon Valley software shop writing code.
Not at all.
Mm.
They are deeply embedded in the messy physical world of laboratory science.
Right.
They analyze actual tumor profiles, they digitize physical pathology slides, and they build out these massive predictive data sets.
And they're building a pretty serious competitive moat in that physical space, right? I mean, they recently partnered with CellCarta.
Yeah, which is a major move.
Right, because Tempus just became the second commercial laboratory partner in their entire network for oncology companion diagnostics that isn't just, theoretical AI hype.
Right. That's ground-level application.
Exactly. Their tech is actively being deployed to help direct real cancer treatments.
And the scientific validation they're racking up is, well, it's what forces the medical establishment to take them seriously.
Because anybody can just slap AI into a pitch deck.
Oh, sure. Happens all the time. But Tempus recently published the results for their PRISM 2 model in Nature Medicine.
Wait, Nature Medicine, that is a massive deal.
It is. Getting past the peer review process of a journal like that, it requires bulletproof data.
Let's actually pause on PRISM 2 for a second, because this is a foundation model for pathology, and that term gets thrown around a lot these days.
It really does.
So for anyone listening who's trying to wrap their head around it, a foundation model is essentially like a master skeleton key. In the old days of AI, you'd have to train one very specific algorithm just to find lung cancer, right?
Right.
And then a totally different from-scratch algorithm to find breast cancer. But a foundation model is trained on millions of diverse tissue samples, so it understands the fundamental underlying language of human biology.
Which changes everything.
Exactly, because once it knows that basic language, you can easily adapt it to unlock almost any specific diagnostic door you want.
That is a brilliant way to conceptualize it. And the sheer physical effort required to build that skeleton key in biology is just staggering.
I can imagine.
Yeah, I mean, training a text-based AI model like ChatGPT involves scraping the internet for text files, but digitizing pathology.
That's physical tissue.
Right. You're taking physical pieces of human tissue on glass slides, running them through incredibly expensive high-resolution microscopic scanners, and generating these massive multi-gigabyte image files for just a single slide.
Wow.
Yeah, so the compute power and just the physical lab infrastructure required to build something like Prism 2 is astronomical.
But I guess the payoff is there, right? Because that Nature Medicine publication proved that their Prism 2 model either matches or, in some cases, completely outperforms existing models.
Yep, when it comes to complex diagnostic tasks, identifying biomarkers, and even predicting patient outcomes.
Which is incredible. And I guess when you have that level of validated technology, you can start commanding serious clinical contracts.
Absolutely. Which completely explains why they confidently raised their full year 2026 revenue guidance.
What's the new number?
They're now projecting to bring in between 1.59695 billion and $1.605 billion this year.
Okay, approaching 1.6 billion in revenue is phenomenal. It's like a brilliant medical student finally getting their first actual paycheck as a doctor.
That's a good comparison.
But here is where the story gets really complicated,
Yeah.
and where I have to look closely at that shiny $5 million Q2 profit.
Uh-oh, here comes the reality check.
Yeah, because if you pull back and look at the trailing 12-month numbers, their net margin is a negative 17.7%.
Ouch, yeah.
So my question is this recent Q2 profit a genuine turning point where the business model finally clicked into place? Or, I mean, is this just a lucky quarter where the accounting simply lined up in their favor?
Well, that's the exact tension keeping Wall Street analysts up at night right now.
Yeah.
To understand what happened, you really have to look at the mechanics of a GAAP profit.
Right, GAAP, so generally accepted accounting principle.
Exactly. It's an accounting framework. And reaching a GAAP profit in a single quarter doesn't necessarily mean your core everyday business operations are suddenly printing cash.
Right, it's basically like signing a massive contract. You get to officially write down in your ledger that you made millions of dollars today, so your books look fantastic.
Sure.
But the operating cash flow is the harsh reality that the client hasn't actually paid you the cash yet. And meanwhile, you still have to make payroll for your engineers and lab techs on Friday.
Precisely. A GAAP profit can be achieved through specific timing of revenue recognition. Like maybe a large milestone payment came through, or certain tax adjustments were applied.
Ah, I see.
It proves they can cross the profitability finish line for a snapshot in time. But it absolutely does not guarantee they won't slip back into the red the moment the calendar turns to the next quarter.
Which brings us directly to the actual bank account, because my skepticism about that single profitable quarter is heavily reinforced when you look at the broader 6-month picture.
The 6-month numbers are rough.
They really are. Despite the Q2 victory lap, their overall net loss for the 6 months ending in June was staggering. It was a loss of over $120 million.
Right, 120.27 million to be exact. And if you look at the trajectory, that 6-month loss actually widened compared to the prior year.
Wait, it got worse.
Yeah, they lost around 110 million in the same period last year, and now it's 120.
Wow. And the cash burn, the actual physical cash bleeding out of the daily operations is even more concerning to me.
Oh, the operating cash flow.
Yeah, it dropped from negative 61 million last year to a negative 80 million for these past 6 months. And if you look at their free cash flow proxy, which factors in all the capital expenditures they have to make on lab equipment and servers, it sits at a negative $95 million.
It's a heavy burn, though we should note they aren't completely running on fumes just yet.
True, they do have a war chest.
Right, they have roughly $600 million in cash and equivalents sitting there.
Okay, that is a solid safety net. But their total liabilities jumped to nearly $1.9 billion.
Yep, 1.921 billion.
So if you're looking at this balance sheet, it just feels like they're putting a fresh coat of paint on a house that has a massively leaking roof. Like, how does a company confidently tell the public they're going to make $1.6 billion in revenue while their actual operating cash burn is getting actively worse year over year?
It's a great question. And to understand that, you have to look at the fundamental economics of the genomic and AI space.
Okay, break that down for us.
Well, this isn't a mature, steady-state industry, right? It's a land grab. In high-growth tech and biotech, scaling up revenue inherently requires massive, front-loaded capital expenditure.
Because it's physical.
Exactly. If you want to process twice as many tumor samples, you can't just copy and paste some code. You have to buy twice as many physical genomic sequencers. You have to lease twice as much physical laboratory space.
Right.
You have to hire specialized, highly paid lab technicians. And you have to rent massive amounts of cloud computing power to train those next-generation foundation models we talked about.
Okay, so the burn question for anyone trying to evaluate Tempus is figuring out the real nature of that cash burn. Is this negative $95 million dollars uh, a strategic, necessary investment to build a moat so deep that no competitor will ever catch them? Or is it a structural flaw? Like maybe it simply costs them $1.20 to deliver every $1 of service, and scaling up just means they lose money faster.
That is the multi-billion-dollar question, honestly. And the answer won't be clear for several quarters. But Tempus isn't waiting around to find out organically.
No, they're definitely not playing it safe.
Right. They are trying to force the issue through aggressive expansion, which brings us to the most critical pivot point in their immediate future.
The billion-dollar elephant in the room.
Yep. The Personalis deal.
Because apparently, when you are burning nearly $100 million in cash every 6 months, the logical next step is just go out and buy a massive competitor.
It takes some nerve, I'll say that.
It really does. Tempus is currently in the process of acquiring Personalis for roughly $1.5 to $1.7 billion.
Right, and this deal is expected to close in late 2026 or early 2027. It's basically the ultimate high-wire act.
Why do they even want Personalis so badly?
The strategic goal here is to aggressively bolster their capabilities in oncology diagnostics, specifically in a field called MRD, which stands for minimal residual disease.
Okay, MRD. This is basically the holy grail in cancer care right now, right?
Oh, absolutely.
For context, historically, after a patient undergoes surgery or chemo, doctors basically just have to wait. They do periodic scans to see if a tumor physically grows back.
Which is terrifying for that patient.
It's awful. But MRD looks for circulating tumor DNA, right? It's essentially looking for microscopic, fragmented needles of cancer DNA floating around in the haystack of the patient's bloodstream.
That's exactly it. And if you could detect a relapse at the molecular level, like months or even years before a physical tumor shows up on an MRI,
You completely change how we fight the disease.
yes, the clinical value of capturing that MRD market is almost incalculable. But the financial execution of this merger, that's where things get incredibly dicey.
I have to push back on the timing here, honestly. They are already losing millions. Their AI and lab operations are already incredibly complex to manage on their own. And now they're going to swallow a $1.5 billion company.
It's a lot to chew.
It's like trying to run a marathon while you're still recovering from a sprint. Merging two companies of this size is never just plugging in an API. You are trying to graft two living, breathing, biological nervous systems together.
That's a great analogy.
You've got totally different laboratory setups, distinct AI architectures, completely separate FDA regulatory pipelines, and probably clashing corporate cultures. Doesn't this massively distract their management team right when they need to be focusing on fixing their own cash flow?
The integration risk is monumental. You are absolutely right about that. The cost of aligning those two nervous systems could very easily wipe out that fragile single-quarter gap profit we were just celebrating earlier.
So why risk it?
Because you have to view this through the lens of the competitive arms race they're trapped in. Just look at their peers.
Like Caris Life Sciences.
Exactly. Caris Life Sciences is a major competitor, and they just raised their own guidance and launched a major new product line called Caris Detect.
So standing still is essentially moving backwards.
100%. In the world of AI-driven diagnostics, scale is oxygen. The company with the most patient data trains the most accurate AI models,
And the most accurate models win the most lucrative contracts.
which generates even more data. It's this continuous feedback loop. Tempus management likely made the calculation that if they don't buy Personalis, a competitor will.
And then Tempus is permanently locked out of that data loop.
Right. They are choosing the massive risk of integration over the fatal risk of obsolescence.
Okay, so we've looked at the groundbreaking foundation models, we've looked at the heavily bleeding balance sheet, and we've analyzed this massive bet the company M&A strategy.
It's a lot of moving parts.
It is. So how is Wall Street actually processing all of this? Because, I mean, human analysts and trading algorithms both have to put a price tag on this chaos.
And right now, the market is pricing in a very heavy dose of skepticism.
The technical numbers are pretty brutal. As of mid-August 2026, the stock closed at $49.36.
Yeah, that hurts.
It's down roughly 37% from its 52-week high of $104. They have essentially lost half their peak value.
And if you look at the technical posture, it reflects a market that really just doesn't know what to do with the narrative.
What do you mean?
Well, the stock is getting a tiny short-term bounce from that Q2 profit headline. It's trading above its 20-day average. But it is heavily suppressed below its longer-term 50-day and 200-day averages. The broader momentum is just decisively negative.
And the sell-side analysts are acting incredibly cautious, too. In August alone, major firms like Piper Sandler, BTI, HEC Wainwright, and Stifel all came out and slashed their price targets.
Did they really? All of them?
Yep. The new targets are hovering anywhere from $50 to $70. Nobody out there is pounding the table calling this a screaming buy. So why is Wall Street so allergic to this stock right now?
Wall Street algorithms and human analysts alike absolutely hate complex, hybrid narratives.
They want it simple.
Exactly. They love clean, easily modeled stories. If you are a pure software company, analysts know exactly what multiple to assign you, because software has, like, 90% gross margins.
Right.
And if you're a pure physical lab testing company, they know how to value you based on lower margins and high physical overhead.
But Tempus is both.
Exactly. Tempus is offering a story that says, hey, we build world-class tech bubble AI, but we burn cash like a heavy industrial manufacturing company, and we're buying massive competitors just to survive.
That's a headache to model.
The financial models simply break down trying to price that accurately, so analysts just default to caution and cut their price targets.
Okay, but taking that a step further, the analysts are just on the outside looking in. What really fascinates me is the insider trading.
Oh boy, the insider trading.
Yeah, because the C-suite executives actually know exactly what the plumbing looks like, and the insider trading picture here paints a very loud, very grim picture. It's not great.
There were 0 open market purchases recently. Not a single executive bought shares. But there were 39 open market sales, totaling over 670,000 shares dumped by insiders.
Wow.
Notably, one executive, Ryan Fukushima, sold 20,000 shares. Just dumped them. If management just delivered their first ever profit, and they have this shiny new Nature publication, why are insiders dumping hundreds of thousands of shares and not buying any? Are they seeing storm clouds we aren't?
It is the most visceral red flag an investor can look at. Now, playing devil's advocate for a moment here.
Okay, sure.
Insider selling is not always a definitive signal of impending doom. In tech and biotech, executives often receive a massive portion of their total compensation in the form of stock.
Right. It's just their paycheck, basically.
Exactly. They routinely sell shares simply to pay their income taxes, to diversify their personal wealth, so it isn't all tied up in one single asset, or frankly, just to buy a house. You can't always equate a mechanical stock sale with a lack of faith in the company's underlying science. That is the generous view, absolutely. And I understand taking some chips off the table, but Zito buys.
Yeah, that's the hard part to justify.
If you genuinely believed deep down that your brand new Q2 profit was the start of an endless rocket ship trajectory, and your own company's stock was currently sitting at a massive 37% discount from its highs, wouldn't anyone in the executive suite be scooping up shares?
You've hit the nail on the head. The selling is normal. The absolute void of buying is the alarm bell. When you combine that insider behavior with the broad analyst downgrades, it signals a very clear consensus.
Which is?
The people closest to the numbers are heavily weighting the risks of the Personalis acquisition way over the triumph of the Q2 profit.
Let's actually drill down into the mechanism of that fear. They are worried about dilution.
Right, exactly. Dilution is the silent killer of stock value. Tempus has to pay for this $1.5 billion acquisition somehow. They don't have enough cash on hand to buy it outright.
Because they only have $600 million in the bank.
Right. So they either have to take on massive high-interest debt, or they have to issue millions of brand new shares of Tempus stock to hand over to Personalis shareholders.
Right, and if they issue a mountain of new stock, the total pie gets bigger.
Which means the specific slice of the pie that you, as a current shareholder, own suddenly gets much, much smaller.
Even if the combined company goes on to be wildly successful and actually cures cancer, your individual shares might be worth less because there are just so many more of them in circulation.
Precisely. The insiders understand that the upcoming financing structure for the Personalis deal could severely depress the stock price in the near term, completely, regardless of how good the AI models actually are.
So if you are analyzing this landscape right now, trying to make sense of the noise, let's just summarize the absolute core tension we've been unpacking today.
Sure, it's a living paradox.
It really is. On one side, you have undeniable peer-reviewed scientific breakthroughs with their foundation models in pathology. They are showing flashes of GAAP profitability and projecting an incredible $1.6 billion in revenue.
The dream.
But that scientific brilliance is heavily anchored down by a worsening operating cash burn, a massive, highly complex acquisition that introduces severe integration risks, and a market that is responding with slashed price targets and executives who are rushing for the exits rather than doubling down.
Yeah. As you watch this story unfold over the next year, the critical metrics to monitor are really twofold.
Okay, what should we be looking for?
First, look past the headlines and focus purely on the path to sustained operating cash flow.
Not just GAAP profit.
Exactly. Can they string together a third and fourth quarter of actual cash generation? A single quarter's GAAP profit is an accounting anomaly. 3 quarters of positive cash flow is a sustainable trend.
That makes sense. And the second thing,
Second, watch every single SEC filing regarding the Personalis deal. Look for exactly how management structures the final financing. If they heavily dilute the existing stock to push the deal through, the market reaction will likely be severe.
it really is a fascinating case study in how the future of medicine is just colliding head-on with the realities of capitalism.
It is. The science is undeniably the future, but the corporate vehicle delivering that science is currently under intense structural strain.
Which leaves you with a much bigger, almost philosophical question to ponder. Something that extends way beyond just the balance sheet of Tempus AI.
Oh,
Yeah. If the only way for these groundbreaking diagnostic companies to survive financially is to aggressively swallow up massive competitors, merge their operations, and consolidate their data sets, who ultimately ends up owning the digital blueprint of human disease?
that is a chilling thought.
Right. If the AI arms race requires an absolute monopoly on data to be profitable, are we comfortable with just one or two massive corporations holding the master skeleton keys to our pathology?
Something to think about for sure.
Keep a very close eye on how these companies merge because they aren't just acquiring revenue, they are acquiring the underlying code of human health.